Welcome to Talk Takers. Hooker Furnishings just dropped its second quarter earnings, and wow, the numbers tell a really fascinating, complicated story. It's like a company at a major crossroads, so let's break it all down. All right, right out of the gate, the headline number was a GAAP loss of 31 cents per share. Now, analysts were expecting a loss, but only around 12 cents. So this was a pretty significant miss, and a miss that big, well, it immediately puts the market on high alert.
So here's the real tension. Despite that big earnings miss and the stock taking an initial dive, management is pushing this self-help turnaround narrative really hard. And that leaves us with the big question. Is this the start of a genuine comeback, or is it just a classic value trap?
Okay, so let's start with those headline numbers that really drove the initial negative reaction because, it wasn't just a miss on one thing. It was a miss on both the top and bottom lines. The revenue miss was pretty stark. Sales came in at just $82.1 million. That's down almost 14% from last year and way short of the $91 million Wall Street was looking for. So you combine that with the earnings miss, it's no surprise the stock tumbled over 12% that day.
Now, this is where the story gets really interesting. If you only look at those consolidated numbers, you're missing the real story. Because underneath that headline, Hooker is basically operating like two completely different companies.
I mean, just look at this split. It's a total tale of two companies. On one side, you've got their legacy Hooker-branded business, and it's actually doing pretty well. Sales were up a bit, and incoming orders jumped an impressive 11%. But then you look at the other side, the Home Meridian or HMI segment, and it just fell off a cliff. Sales plummeted a staggering 44.5%. So you're probably wondering, how does a business segment sales drop by nearly half? Well, on the earnings call, management kind of broke it down for us. They said about 40% of it was just weird timing on some big hospitality projects. Another 35% they blamed on the tough economy and new tariffs on imports from Vietnam. And the last 25%? That was from losing a major customer who went bankrupt. A perfect storm, really.
So, faced with this total collapse in their import-heavy business, management isn't just sitting back and waiting for the market to rescue them. No, they're going on the offensive with a very clear, multi-part restructuring plan.
And the plan really boils down to three main things. First, and most importantly, they're going to aggressively cut their fixed costs. Second, they're working to optimize their whole supply chain, which includes a new warehouse over in Vietnam. And third, they're still going to invest in specific growth areas, like their new Margaritaville collection that's coming soon.
Now, the absolute centerpiece of this entire strategy is the cost cutting. Management is targeting $25 million in yearly fixed cost savings. And to give you some perspective, that's a massive 25% reduction from their spending last year. They're moving fast on this too, expecting most of it to be done by the end of the third quarter. And the CEO, Jeremy Hoff, was super clear about the goal here. The whole idea is to remake the business so it can be profitable even if sales stay this low. They're trying to control their own destiny, realigning their costs to match the reality of today's weaker market.
Of course, this whole self-help story is happening against a really tough economic backdrop. The company didn't give any specific financial guidance, and the call made it pretty clear they are battling some major headwinds. And these headwinds are no joke. There's a new 20% tariff that directly hits their HMI business. At the same time, super high mortgage rates are keeping the housing market on ice, which means fewer people are buying furniture. And all of this is made worse by inflation, which is squeezing the exact kind of value-conscious shopper that HMI caters to. So let's put it all together. You've got the huge earnings miss, this massive split inside the company, an ambitious turnaround plan, and a brutal market. What does it all mean for the stock? Let's get to our rating and what we're watching for on the next call. Here's how you can think about it. The bull case is that the $25 million in cost savings actually works. It creates huge operating leverage when sales finally stabilize. Plus, that Margaritaville launch could be a surprise hit. The bear case? Well, it's pretty simple. The HMI sales drop is so bad that it just eats up all the cost savings. The tariffs and the economy get even worse, and maybe the company even has to cut its dividend. So our rating on this is market perform. Look, the cost-cutting plan is absolutely credible, and the legacy brands are showing some impressive strength, but the execution risk over at HMI is just too big to ignore. A 44.5% sales drop is a massive red flag, and until that business shows a clear sign of hitting bottom, this is what we'd call a show-me story. And that leads us to the key question for next quarter. It's really a race.
Can the benefits from all that cost-cutting finally start to outrun the drag from HMI's terrible sales? We'll be watching to see if their overall operating loss starts to shrink. Q3 is really going to tell us who's winning this race, the internal savings or the external pressures. This is not financial advice.